In 2023, Americans paid $130 billion in credit card interest. Not spending, not purchases, just interest. Money paid for the privilege of paying late. And here's the part that should actually bother you. Most of that money didn't come from people who were irresponsible. It came from people who were doing exactly what they were taught to do: pay the minimum, stay current, don't worry about it. Nobody ever sat you down and explained what a credit card actually is. Not really. You got the marketing version, cashback points, build your credit. What you didn't get was the version where I show you the math the bank is running on your account every single month, whether you notice it or not. So today, I'm going to show you exactly how a credit card makes money off you, the mechanism, the numbers, the traps, and more importantly, how to flip the entire thing so the bank is working for you instead of the other way around. Stick with me, because by the end of this, you'll understand your credit card better than most bank employees do. If you want more videos that explain money with real numbers, not financial myths, hit like, subscribe to Wealth Decoded, and let's get into it. Let's start with the part nobody explains properly. How does a credit card company even make money? You'd think it's the interest, and yes, that's part of it, but there are actually 3 separate revenue streams happening every time you swipe, and most people only know about one of them. The first is interest. The average credit card APR in the United States right now sits around 21%, not 2%, not 12%, 21%. If you carry a $5,000 balance and only make minimum payments, you'll pay roughly $5,500 in interest alone before that balance is gone, almost doubling what you originally spent. The second revenue stream is the one most people have never even heard of: interchange fees. Every single time you swipe your card, the merchant, the store, the restaurant, the website pays a fee to your bank, usually between 1.5% and 3.5% of the purchase. You don't see this fee. You never pay it directly. But it's baked into prices everywhere, which means even people who pay cash are quietly subsidizing everyone else's credit card rewards. The third stream is fees: late fees, annual fees, foreign transaction fees, balance transfer fees, individually small, collectively billions of dollars a year. Here's why this matters. The bank doesn't actually want you to default. That's bad for them too. What they want is for you to carry just enough balance for just long enough to maximize interest without ever missing a payment. That's the entire business model. You staying in debt quietly, manageably, is the product. Now let's talk about the single most expensive habit in American personal finance: paying only the minimum. Here's how the math actually works using real numbers. Say you have a $5,000 balance at 21% APR and your card's minimum payment is 2% of the balance. If you pay only the minimum every month, it will take you approximately over 18 years to pay off that $5,000. And by the time you're done, you'll have paid more than $7,800 in interest on a $5,000 purchase. That's not a typo. The minimum payment isn't designed to get you out of debt efficiently. It's designed to keep the loan alive as long as legally possible, because every extra month is more interest collected. And here's the psychological trick that makes this so effective. The minimum payment is intentionally small enough that it feels manageable. $100 on a $5,000 balance doesn't feel like a crisis. It feels responsible. You're handling it. That feeling is exactly what keeps the debt alive for nearly 2 decades. Compare that to paying just $200 a month instead of the minimum. That same $5,000 balance gets paid off in under 3 years, and total interest drops to around $1,900, a difference of almost $6,000 just by paying a fixed, slightly higher amount instead of the bank's suggested minimum. This is the single highest leverage move in this entire video. Never pay the minimum on purpose. Pay it only when you genuinely have no other option. Here's something almost nobody explains correctly. Your credit score isn't just about whether you pay on time. It's also heavily influenced by something called credit utilization, and most people are accidentally hurting their score without realizing it. Credit utilization is simply how much of your available credit you're using at any given moment. If you have a $10,000 credit limit and you're carrying a $7,000 balance, you're using 70% of your available credit. Even if you pay it off in full every single month, that 70% utilization can show up on your report and quietly drag your score down, sometimes by 50 points or more. The number you want to stay under is 30% utilization. Ideally under 10% if you're trying to optimize your score for something specific, like a mortgage application. Here's the part that surprises people. You can do everything right, never miss a payment, never carry debt long-term, and still have a mediocre score just because your utilization runs high relative to your limit. There's a simple fix that almost nobody uses. Ask your card issuer for a credit limit increase without using the extra credit. If your limit doubles and your spending stays the same, your utilization percentage drops automatically. Same spending, same habits, better score. Most people have never made this one phone call. Now here's where this gets actually useful. Because used correctly, a credit card isn't dangerous, it's one of the most powerful tools in personal finance. The entire game changes with one rule: pay your statement balance in full every single month, no exceptions. If you do this, just this one thing, the interest rate becomes completely irrelevant. It doesn't matter if it's 21% or 30% because you never carry a balance long enough for it to apply. Once you've mastered that, the card flips from a liability into an asset. You get purchase protection most debit cards don't offer. You build credit history, which affects your ability to get approved for a mortgage, a car loan, even some apartments. And depending on the card, you get cashback or travel rewards, essentially a small percentage refund on money you were already going to spend. The people who win with credit cards aren't the ones who avoid them entirely. They're the ones who treat the card exactly like a debit card, never spending money they don't already have, and just collecting the rewards as a bonus on top. The card itself isn't good or bad, it's neutral. It just amplifies whatever financial habits you already have, good or bad, and makes them bigger. Mistake 1: closing old credit cards to simplify. This shortens your credit history and raises your utilization percentage instantly, often dropping your score by 20-40 points overnight. If a card has no annual fee, keep it open even if you stop using it. Mistake 2: applying for multiple cards in a short window. Each application creates a hard inquiry that temporarily dings your score. Space applications out by at least 6 months unless you have a specific strategic reason. Mistake 3: chasing rewards on a card with an annual fee you don't actually use enough to justify. A $95 annual fee card only makes sense if the rewards you'll realistically earn exceed $95. Most people never run that math, they just see rewards and assume it's free money. Here's what I want you to do this week. Open your credit card app right now, or do it the second this video ends, and check 2 numbers. First, your current utilization percentage. If it's above 30%, your priority this month is bringing that number down even before extra debt payments elsewhere. Second, your APR. Just know the number. Most people genuinely have no idea what interest rate they're paying, which means they have no idea how expensive carrying a balance actually is for them specifically. 2 numbers, 5 minutes, that's the entire assignment. If this changed how you think about the card in your wallet right now, subscribe. I post a new video like this every week. Next week, how compound interest actually works, with real numbers that show you exactly what starting early is worth. Comment your current utilization percentage below, or just comment checking now if you're about to go look. I'll see you in the next one.